Greetings. It's been a little bit since we've had a market minute. The market has been a little bit crazy, so I apologize for the delay, and this one may be slightly longer than a minute. To say this has been a challenging start to the year would be putting it lightly. And what I'm finding is that it's not so much the drop in the market, but the ride along the way. And here's kind of what I mean. If you look at the first quarter in the S&P 500, we saw a drop by about 4.6% for that quarter. And that's with some nice rebounds in March. So it felt like the world might be leveling out. It might be we're going to be through this. And then really the bottom fell out of the market starting in basically April 5th. And really just for April alone, we saw a loss of another 6.9%. And so right now, year to date, the S&P is sitting at right around 11.47% down. But bonds are doing okay, right? Not so much. If you look at the Bloomberg U.S. Aggregate Bond Index through the first quarter, through the end of March, the bond market was down by about 5.93%, almost 6%. And that meant that the bond market at that point was actually losing more than the equity market, than the S&P 500. And just like the S&P 500, we actually started to see some life in late March, only to have April hit and we lost another 3%. So year to date in the bond market, we're down by roughly 9%, S&P's down by almost 11.5%, and the Nasdaq's taking the brunt of most of it. It's down by almost 19% as of this recording. So a tough market all around, and with bonds and stocks both being down, I've seen article after article after article asking, is the 60-40 portfolio dead? I actually don't think it is, and I think a little context may help. The first context is just a reminder of how amazing the last 13 years have really been. If you look at the average rate of return in the S&P 500 from 2009 to 2021, the average rate of return was actually 14.2%, just a little over that. But if you look at the previous 40 years in the S&P 500, the average rate of return was actually around 7.5%. So we've been living in a really great, blessed time the last 13 years. And drops that we are seeing now, we're reminded are kind of part of the game. The second bit of context I think is helpful is what is driving this odd mix of both bonds and stocks dropping. And frankly, I think the primary driver here is really inflation. The easy money policies over the last 13 years have really finally caught up with us. And we're at the point where we have to start paying the bill, and we've got to get inflation under control. Now, to give you some context of the excess money that we actually have in the system, over the last, and I'm going to get slightly nerdy here, so I apologize, over the last 63 years, since 1959, the M2 money supply in the economy has actually grown by about $21 trillion, give or take. And the challenge with that number is that 62% of that increase has actually come in just the last 13 years. And to give you a sense of what that scale and what that means, for the 50 years between 1959 and 2009, the money supply increased, but it increased at an average rate of about 163 billion a year. Now, in contrast, between 2009 and March of this year, the average increase in the money supply was $1 trillion a year. And to put that in equal terms, that means we went from 163 billion a year to 1,000 billion a year. But it gets worse. In the last 2 years, February of 20 to March of 22, the money supply has increased by over 3 trillion a year. And the challenge is all that excess liquidity in the market has met supply chain disruptions as a result of the pandemic. And here we are with too many dollars chasing too few goods. Now, the Federal Reserve is stepping in and working their playbook of increasing rates. The problem is that when the Fed begins to raise rates in order to help soak up some of that liquidity, two things drop. Bonds drop because interest rates are on the rise, and equities drop because, frankly, Dad is taking the credit card away. And so where do we go from here? What's next? Well, Mark Twain once said that history doesn't repeat itself, but it often rhymes. So if you look back in time to the 70s and early 80s, we had a very similar event. The average inflation rate from 1970 to 1982 was around 7.6%, which kind of feels like where we are now. And the average rate of return in the market in the S&P 500 was only about 4.8%. Then 1981-ish, Paul Volcker steps in as the chairman of the Fed, and he started raising rates to get inflation under control. And while very, very unpleasant at the time, the result was that over the next 13 years, the inflation rate dropped to less than half of what it was in the 70s, and the average rate of return in the S&P 500 grew to about 12.7%. So I think there's some hope for the future given what we've seen in the past. And I don't think it's time to abandon the strategies that we have in place right now. But it is a reminder that diversification is still key, and not just diversifying between stocks and bonds. Insurance, equities, bonds, real estate, commodities, and the whole range of options that we have available are key when it comes to diversification. Remember, the bad times in the market are where portfolios are actually strengthened, because we're reminded of what the world looks like when it's not always up and to the right. If you want to have a look at your portfolio or go into more depth on some of this and kind of where we are and where we're heading, let's set up a meeting.